In this video, we will be talking about the most underrated trading strategy and why you should be doing it in 2023, and that is the swinging strategy. One of the fundamental root of success that brought me to where I am today is truly diving deep into the realm of swinging. After doing it myself, and you guys have witnessed it, I think last year, around $1 million was flipped. What was it? Swinging. And this is the context of today's video, whereby I think you guys are now ready to explore into a different side of trading. It is not fun, but it can be profitable to some. So in this very video, I'll break down from how do you swing to which pairs that works well with swinging and all the fundamental aspect that you truly need. Because in the end of the day, the knowledge that I'm giving down to you guys can be absorbed, but it needs to be applied and tested for yourself so that it suits yourself later on. So now let's begin to how do we swing and who should swing. So in the world of swinging, like I said again, there are two types that you can go down. One is the classical route and one is the volatility swing. Number one, the classical swing strategy is more focused on the duration to achieve the target TP, and the reason to this is the selection of our pairs would be those soft currencies, but the behavior of the movement is what we call one directional. So under the classical swing pairs, my top 3 favorite swinging pairs that you don't need to experiment for yourself to obtain this list, just follow this. Number 1 is USD CHF. This is the king of swings. Number 2, the prince of swinging, NZD USD. Somehow or another, these two pairs that I've just mentioned, they have the best manner or the best behavior to not retrace when they start to move. If you don't believe me, go down to the charts yourself, scroll through the H4 daily candles of NZD USD and USD CHF. You will see there are not much wicks between the daily candles or the H4 candles. Meaning to say, if you were to sell at top, you can hold open-mindedly with a break-even without fearing it coming back to retest and shooting back down. This is the advantage of classical swing pairs. And number 3, my least favorite is Euro JPY. Simply because I used to have a huge trauma with this pair, but if you were to look at Euro JPY as a pair to swing, I want you guys to dive deep into the H4 and daily only. You will start to see some basic pattern within this pair, and then you will start to see across a week to 2 weeks, you can obtain 300 pips from the entry that you took. So we will go into the charts later, but this is my top picks for the classical swing pairs. So now we are going to be discussing in the technical approach on how do we swing. And of course, in every trade that you are trying to take, you have to have an approach or a certain process that goes within it. So in swinging, I think it's best to start with being able to identify where is the beginning of the movement and where can the potential movement end on the bigger time frame. That's the keyword, on the bigger time frame. So it's best if you're talking about the classical swing pairs, we only focus on the monthly and weekly. So on this video, I'll be using USD CHF as a reference point to the processing on how do we go on identifying our potential zones to be beginning the potential swing. So now, diving deep into the iPad, we always begin in the biggest form of time frame because swinging is all about having the mentality of the big investors, and hence one thing about them is they do not rush in chasing the potential profit. So where if you start focusing on the M1, M5 and M15, you're going to be confused the hell out in the market, and hence what you're going to be doing is scalping or intraday and not swinging. Or if you manage to get suddenly a 300 pips from an M15 setup, you have to understand potentially that M15 setup was then within a certain bigger time frame zone. So the root to all of it is still mastering the bigger time frame. So now let's talk about this particular chart. So as you guys know, we use the engulfing theory, and by doing so, we are able to always identify where is the beginning of the movement and where can potentially be the ending of the movement. So let's talk about this recent drop. So this recent drop versus all the other drops, the difference is, firstly, it took only 2 monthly candles to dive around 890 pips, whereas the rest of this took more than months, maybe years, to go even lower. So what happened over here? This is whereby we have to start identifying things. By using the engulfing theory, we always begin before the breakout happened and before the sideway was formed to then understand, is there something on the left hand side that we can potentially make a reasoning out of. So for this one, it's very, very simple. So this is an engulfing buy. The engulfing buy is the region whereby we mark the whole candle that is devoured by the bullish element. So this red candle is eaten by this particular candle because this candle closed right above the box, meaning it closed right above the peak of this bearish candle. So this then gives us a zone, and this zone is what we call an engulfing buy zone. The basic theory of it is, from this zone, technically it has shown us that the market potentially contains a lot of strong buyers. From where? From the price region of 0.99288 all the way to 1.03470. So by the layman's term, this can potentially be a demand zone. So let's not talk about after the breakout. Let's follow the sequencing. Once the bullish engulfing was formed, we can see the market starts rallying up. And then where did it go? It stopped right at the engulfing sell region. So understanding this, it moved from zone to zone. Why is this zone not relevant to us? Simply because this was an engulfing sell, and this engulfing sell was then broken by an engulfing buy. So this zone is just a high liquidity zone, but it's not the critical level. Hence, the market will make its way into the critical zone and hence rejected back into the box. So by the theory of the demand zone, it should have been a buy when price came in here. Maybe yes, if we look down in the daily candle, within the zone, there must be some buys. See, pum. But on the monthly perspective, it dropped and it broke. So once it broke this particular zone, it broke it and leaving an engulfing sell within it. So this is giving us a confirmation whereby prior to this, buyers were living in this zone. Now sellers have taken the dominance. When this happened, this is whereby a continuation breakout happened for USD CHF. Where did it stop? So this was the period of time it created the all-time low, meaning the beginning of that was somewhere within this location. So moving on from there, having this guy over here defining this area as a high liquidity area, then now we have this first engulfing cell indicating the price location for the first move that happened. So once price dropped, went back into a sideway, do you see how strong this zone was rejected again and again and again? And look, even when it spiked, it still respected the high liquidity zone. Oops. It respected the high liquidity zone. It respected the zone again. It respected this zone. So do you see the failure to break this zone then caused gold to do what? A breakout upon another breakout. Now when we have understand, there was a monthly sell setup whereby within our sell zone, now it has formed 1, 2, 3, 4, 5, 6 engulfing cells. Hence meaning to say USD-CHF has now taken a very strong sell bias in the monthly candle perspective. So who can stop the rally of a monthly candle sell push? Only the monthly buyers. So do you see why when people are trying to buy over here, they are still in red? Because when the sell setup from the monthly happens, it will find its way into the minimum monthly buy. So hoping that the buyers here can reduce the selling pressure. So now we are entering the location whereby for USD CHF monthly, a strong buy zone can emerge somewhere within this area. So using the engulfing theory, it's more of an inception. We can find zones within zones. So from this saturated area, we can then filter down into the weekly candle, looking for potential zones within this blue area. It can slightly be lower, it doesn't matter. But where is the fresh zone that we can technically use for a strong spike? So deleting this guy out, after we have gotten a rough monthly idea to where we must look, now we can find from the weekly perspective, there is an engulfing cell indicating that previously this blue zone is a seller's zone. In the future, when price broke out, it started using this zone as a support zone. And from there, we can see, due to the failure of it breaking the low of this candle, this is now acting as the critical support. So this is where you can see when USD CHF entered within this zone, what happened, it left a wick from the zone that has engulfing buy, meets engulfing buy, meets engulfing buy, and now we jump into M15 to see, or H1. Let's take a H4. So do you see how it rejects from the saturated area? So this is then whereby soon you will see somewhere within this area or this area, USD CHF could start a potential bullish rally. For how many pips? Maybe 250 to 500 pips coming soon. So then monitor this. This is the slow processing to how we start to filter down where do we find our critical level. The word is to potentially begin our swing layers. Swinging, on the other hand, is not like full margin. You don't just whack all of it in. You put down slow entries and you enter the market upon the movement. So this allows you to have more room for margin in your account, and this gives you more relaxation to hold your trades with an ease of mind. This is how you do it, handling the classical swing pass. To go deeper into this, check out my previous videos. We have more in-detail reviews on the engulfing as a whole. Now let's go into the next.